In this final video on capital structure, we're going to talk about how companies might choose what the optimal level might be. And again, this is kind of theoretical, but I think all this information is fairly readily available for certainly most investors, I would think, and the company has information that we don't. So I think this information is all there for companies to use. We need information for the security market line. We need to know what the cost of equity is. So this company has a beta of 1, risk-free rate 6, the market premium 6. So we end up with a cost of equity around 12%. They don't have any debt. The weighted average cost of capital then is 12%. And the tax rate's 25%. No short-term investments, no preferred stock, 10 million in shares. So what's this company worth? We plug in our formula. This company is worth roughly $750 million. How's that break down? Obviously, 750, there's no short-term debt, there's no debt. $75 is the value of this company's stock. We can contact some investment bankers, talk to some people that deal with debt, and ask them about the cost of borrowing money. So for this information, we look at proportions of debt. So if a company wanted to have a 30% debt in their capital structure, investment bankers say they would probably pay about 8.5%. If they wanted 50%, it would be closer to 12%. Now, so let's think about what we're talking about here. We're going to talk about increasing or changing the amount of debt in a company. This is what's referred to as recapitalization. We're not going to buy any new assets. We currently have no debt. We're going to borrow, let's say, 30%. What are we going to do with that money that we borrow? We're going to use that money to repurchase stock. So we're now going to change from 0% debt, 100% stock, to 30% debt, 70% stock. What happens is we know that there is something referred to as Hamada's formula, but Medigli and Miller imply through their theories that beta is going to change if leverage changes. So this beta sub u here, this is what we also might refer to as the unlevered beta or the asset beta. That number is going to be influenced and changed as the company borrows money. So if they had zero debt, it would be this number, obviously, right? Be some zero. The beta that you and I see that's published for us is the beta that's influenced by the company without debt and the company with debt. So if we talk about a company that has 20% debt, what will that company's beta be? Well, it's their regular beta, the unlevered beta, plus 1 minus the tax, times the relationship between debt and equity. So this company, their beta will change from 1 to 1.188. So their cost to equity changes. So now their cost of equity is now 13.13%. It was 12%. So what's the weighted average cost of capital? It's 20%. 1 price times their 8% is what it costs to borrow at 20%. 80% of the 13.3. So now their weighted average cost of capital is now 11.7%. So if we do that for all of the capital structures that we're considering, what does that look like? Here's the cost of debt we got from our investment bankers. Here's the weight of equity. Here's beta then. You see that beta increases as we borrow more money. That means the cost of equity increases as we borrow more. The weighted average cost of capital, 12%, now it reduced to 11.7, 11.6, but then it starts to rise again. So the minimum amount of weighted average cost of capital is 30%. So we really don't have to go any further. That will be the point at which we will have our optimal capital structure. But what we'd like to know is how does that play out for us when we look at value? How's the value change of the company? So the value at 20% debt, again, here's our 11.7 at 769.23 million. So the new debt is 20% of that, 153. Equity, 80% of that, 615. So again, let's look at this in tabular function. We see here's those numbers we just did, right? 8%, 80% equity. There's our beta, cost of equity. Cost of capital is 11.7. So the value of our company here is 769. 153 of that comes from debt and 615 comes from equity. Now again, we know 30% is the best number. 30% gives us the optimal value of the company. So that's the optimal capital structure. It's the point where weighted average cost of capital is minimized. So how does this repurchase thing work then? How do we buy back stock? So before debt, again, we had the value of the company was $750, but now we borrowed money. We borrowed $153, right? So that's our debt level. So that actual is short-term debt, right? So we add it there. Now we have here our company's worth $923. Subtract out the debt we have. 769 is the value. There's, again, the number of shares is 10 million. So now the stock went up to $76.92. So total shareholder wealth is the stock plus the cash. What we're going to find is something that might seem a little strange. The repurchase actually has no effect on the stock price. Now, that's not to say if a company announces a repurchase that the stock price won't change. What we're saying is structurally, if you think of in the paperwork kinds of things, the stock price shouldn't change. But if the price does change, it changes because of the information that's given to shareholders. So if investors think it's a good thing, the stock price is going to go up. If they think it's a bad thing, the stock price will go down. So the first thing we need to figure out is what is the remaining number of shares after the repurchase? In other words, how many shares do we buy back? Well, the new debt depends on the repurchase shares and the total dollars used. So new debt minus the old debt. So it's 153.85. That's how much new debt there is. Now you take the 10 million shares before, subtract from that the 153.85 divided by the old stock price. So we're actually going to buy back 8 million shares. After the repurchase here, you see 769 is the value of the company. We use this short-term debt to buy back the stock. So again, we currently still have this 153.85. We still have that debt. Here's the new value, the stock price, 615. Now you divide it by the 8 million shares left. The stock price is the same. So now at the end, after this repurchase, shareholders are no better or no worse off because of the repurchase. So what did the repurchase do? It changed the value. Because we changed financing, it changed the value of the company. Now, what we did with that, since we're not using it to increase the operations of the company, all we're doing is mixing money between new investors, in this case creditors, and the old one. So really, we're not changing anything in the financing mix at all other than rearranging capital structure. So again, what does this mean? Short-term investments fall because that was what we used. That was the cash we used. Stock price is going to be unchanged. The value of the company goes from $769 to $615 because, again, we use these short-term investments. The wealth of the shareholder stays the same, $769, because now the shareholders don't just have the stock, they also have those short-term investments. So what does this tell us in the end, in tabular form? What does it tell us? At 30%, what we see is what? Here's the cost of debt, weight of equity. We have 70% equity at 30% debt. We have this higher beta, 1.32. The value of this company is $771. That's the maximum value. Now, how that is split up is irrelevant. The price now is $77.17. That's the maximum value. Now, one of the things that they tell us is that really there's not that much difference in value from 20 to 30. So maybe in this range here, that's our target. We want to be somewhere in there, right? That should give us a higher price or a higher value for the company's stock. Now, there are some shortcuts that we can take. So very shortcuts. Let's think about what the value of the stock will be at the end, right? So the value is, it's 1 minus the debt equity, so that's the weight of equity, times the value of operations. So at 20%, the company's worth $769. Stock will be $615. What will be the shares at the end? What will those shares be? The new post repurchase, you take the shares before, multiply the difference between the value of the old and the debt, the value new, debt new, divide that by the value of the old, of the new minus the debt old. So this just gives us a relationship now of the debt equity. So we end up with, again, that 8 million shares. What's the price at the end? Take the value of the new minus the debt of the old, in this case it was 0. Divide that by the 10 shares, the 10 million shares we started with. The new stock price, or the stock price at the end here, is $76.92. And if we sneak back here, we'll see at 20%, that gives us our ultimate price. So again, it's just a way, kind of a shortcut to take to figure out exactly what the optimal value should be. And again, these weights are all pretty close, right? There's not a big range here. So what they're saying is the optimal range is actually pretty flat. But the weight of debt, again, gives us the highest corporate value. Again, I think this is this is a typo. I think this should actually be 20%. So between 20 and 30 seems to be a little bit, if you look at here, 76 to 77. At 40%, it's 75, right? So that value is a lot less than this. So I'm thinking the optimal range, or our target, should be somewhere around here to 20 to 30. Again, that's kind of a long, involved set of videos. It's a complex question. We know that managers spend a lot of time thinking about this, right? Their decision has many, many implications for the company. It has implications on financial distress. It has implications on taxation. It has implications on the return that goes to owners. It has implications to dividends, to the investment opportunities of the company. It's a very, very complex question. And quite frankly, I guess we don't have any real answers, right? There's no real tool that you can plug in that's going to give us ultimately an answer. This gives us a ballpark, but it's not an answer that says if you want the optimal capital structure, it should be 29.87%. There's no number, no tool that gives us that amount of specificity on where we should actually be. Thanks a lot for listening about capital structure. I'll see you in another video.